Welcome back. Let's get chatting with the management of Lumax Auto. A good reported set of numbers that came in on a consolidated basis. Their revenues increased by 50%. The net profit increased by 55%. The stock doing fairly well in today's trading session as well. And that's exactly what the street was anticipating as well. A good performance. But more importantly, a strong outlook for FY26. We're joined by Anmol Jain, who's the MD of Lumax Auto Tech, to discuss the quarter that passed by, but more importantly, the next year. Thanks a lot, Anmol, for joining in. Let's start with the outlook for 26 itself. What are you penciling in when it comes to revenue as well as margin expansion? And more importantly, I'd like your thoughts on two things. One, content per vehicle. And secondly, the acquisition that you had made, right? You said that it could be about 600 to 650 crore worth revenue in FY26. Are you on track for that?
So thank you very much. Yes, FY25 was a good year. Before I get into the FY26 outlook, I think it's important to understand we just kickstarted a midterm plan up until FY31. And one of the factors is that we continue to aspire to grow at a minimum 20% CAGR year on year going forward. So for FY26, our outlook is pretty similar. It's probably a 20 to 25% top line growth. Backed by a strong order book, backed by new launches, backed by increased wallet share, also backed by a full year realization of certain new initiatives which were taken, be it the green fuel acquisition or certain other SOPs which we went into FY25. In terms of margin, I think the company has done fairly well in FY25. We do expect maybe another 80 to 100 bips margin expansion in FY26. This is again in continuation of our vision to attain a 20% EBITDA margin in the future. It's not time sensitive, but hopefully in the next 7-8 years, we should be able to get to that milestone as well.
All right. Hi, Anmol. Good morning and good to see you. When the acquisition, green fuel, I think earlier you were talking about around 350 crores in the coming year. What kind of contribution will it give? And that one's already doing higher margins, right? I think margins are already around 20%. So that helps the entire trajectory. So tell us about this. How do you see this business scaling up FY26, FY28? And also, as Mangalam asked, content per vehicle, what is it at? If you're going to be moving to a blended 20% margin, this as well has to go up, right? So tell us.
So absolutely, we are very bullish on the CNG outlook for the passenger car industry going forward. And again, that was one of the reasons why we strategically went into green fuel. I think for FY26 per se, on a full year consolidated basis, green fuel should be upwards of 300 odd crores. That's the sense I'm getting. The CNG models are still doing well across OEMs. But if I were to give you a more 5 to 6 year horizon, I think this company has the potential to even come to close to 800 to 1,000 crore top line. And that's the kind of growth, that's the kind of penetration of CNG, which we are eyeing over the next 6 years. So clearly, it will contribute a lot more to the overall pie by FY30-31. I would not be surprised that 10% of the consolidated revenues comes from green fuel alone over the next 5 to 6 years.
Content per vehicle?
So content per vehicle, let us say, if I were to talk about Lumax Auto Technologies as a whole, we are currently at about 35,000. The addressable content per vehicle could be up to almost doubling that to almost 70,000. One would be the CNG, certain products where we are not on the CNG delivery system today. We are not on the tanks, for example. And again, that's something strategically we may evaluate going forward as the regulations change and, the type 4 tanks come into play. Also, there is a lot of focus on the SDV, software-defined vehicles. So we've actually kickstarted a new vertical within Lumax Auto Technologies, which will try to integrate all the different components and hardware which we sell to the customer to make us a system integrator, a tier 0.5 of sorts going forward, thereby again increasing the value content per vehicle.
Interesting that you've upped this guidance to about 800 to 1,000 crores in the next 6 to 7 years. I remember you saying this could be about a 600, 650 crore business over the next 4 or 5 years. So that's an interesting one. But, just a point on your overall, if you look at the organic versus inorganic sort of revenue, you said that in your North Star, 20% CAGR comprises of 15% organic and 5% inorganic. You've made one acquisition. What are the other areas where you're eyeing any opportunities? And can we hear of anything in the next couple of years?
We're always evaluating opportunities. Currently also as we speak, the company is evaluating one or two opportunities. I don't think we will probably hear anything in FY26. We like to get in, stabilize things. Yeah, that's exactly how we went into IAC in 2023, stabilized in 25. We just picked up the rest 25%, went into green fuel in 25 as well. So I think not for FY26, but we definitely are looking at few themes. It could be related to exports. It could be related to lightweighting. These are certain trends which we feel could be areas where we would evaluate the next inorganic move in. But again, it's too premature and soon for me to say or comment on it.
Right.
I think FY28, by FY28, we should have something in our kitty in terms of the next inorganic move.
And what's the war chest that you've assigned to this? Because you do have some debt on your books. You have about 220 crore worth capex plans as well. So what's the room for any sort of acquisition? How does your balance sheet digest it?
So first and foremost, I think the filters are that in any inorganic move we make, should be margin accretive. These are not turnaround businesses. We saw it with IAC. We also saw it with Green Fuel. These are margin accretive business for the consolidated entity. They operate already at a higher EBITDA margin than the consolidated numbers. In terms of the free cash, let's say the company is already sitting on more than 300 crores of free cash. Also with the integration of IAC and hopefully going forward once, post-regulatory approvals, the entity is merged into the Lumax Auto Technologies standalone. We will also have a double down on the free cash. We will be able to utilize the balance sheet, leverage the balance sheets in a much more aggressive manner by utilizing IAC's free cash in the next inorganic moves. So that's the strategic plan. How do we move forward on inorganically?
And just help me understand this with regard to IAC, since you mentioned it a couple of times. You had 75%, you're buying the remaining 25% and then merging the entity, right? What is the agreement then with the parent in the United States? Do you have to pay any kind of royalty, any kind of technical fees?
So number one, the engineering capabilities on design, future technologies, we have that 100% in-house. We have a R&D center with more than 350 engineers sitting out of Pune. And we've made an offshoot in the north as well recently. So we are a full service provider of end-to-end solutions of interiors. The parent company still would continue to have a technical agreement and give, let's say, the cutting edge technologies. These would be more, Nigel, on sustainable materials. I think we're still at the tip of the iceberg when it comes to sustainable materials usage in the interiors, whereas North America is really leading the pack, in other countries like Europe as well. So those kind of cutting edge technologies we will have access to through a technology license agreement. But to meet the Indian consumers and Indian OEMs demands, and let's say, kind of evaluating what are the future trends in countries like China, which I personally feel is years ahead in terms of the HMI interface and the whole interior cockpit and cabin feel. So we would be getting a lot of these technologies now from China as well, with certain TAs and, but yeah, the parent IAC continues to support technically going forward.
Royalty you'll pay? Technical fees will you pay?
As of now, there is no such discussion, but as and when we do lend some technical support, we will discuss those at that point of time.
Okay.
Do you have any conscious thoughts on our aftermarket? How does that do for your margins? Because as a proportion of your sales, it's come down versus last year, obviously because of other factors as well, but at around 10%. Is there a strategy here?
So absolutely. I've always been very bullish on the aftermarket. The reason why you see a dip in the percentage contribution is because other businesses have fared.
Exactly.
I think aftermarket by itself grew about 5% last year. This year we have a pretty aggressive plan, and more than a plan, I think the whole thought process and strategy has shifted in the aftermarket to focus more on the demand generation. So there is a lot of work which has gone in, planning the entire length and breadth of the country, which district we have to have increased presence, backed by a strong product development. So I personally feel this year we should look at a healthy double-digit aftermarket growth. The early signs of Q1 already suggest, April month was a good month for the aftermarket for us already. So I'm pretty confident that this year we should look at a healthy growth in aftermarket, and it will come back on track to, again, provide a better consolidated margin. Because as you rightly said, aftermarket does operate at a higher margin than some of the other OEMs businesses we have.
All right, Anmol, thanks a lot for joining in and giving us your outlook for FY26 and beyond. We wish you good luck. Hope for you to achieve all of them, and then we come back and discuss all of this with us as well. Just keep an eye on the market, though, as we speak.